Hello, and welcome to Taxes in Retirement. I'd like to congratulate you for spending the next 40 minutes with me learning about ways that you can improve the financial security of your retirement. But before we dig into the material, I think it's important for us to understand the backdrop financially and demographically that our retirements are positioned in. You see, we're at a really unique time in history. This is the doorstep of a historic moment, and we have never seen anything like this before in America's history or in anyone's history for that matter, because this is really the first time that this has ever happened on planet Earth. This is not one event, it's more of a condition or a situation, and it is getting bigger every single day, and it's going to affect everybody here on this seminar and going to have dramatic implications for our nation for the next 30 to 50 years. What makes this so potentially dangerous is that we have no experience dealing with anything like this as a nation, and as individuals, we're radically unprepared for it. Now, you might be wondering what I'm talking about. And what I'm talking about is retirement. I'm talking about baby boomers, the largest generation of people born in our country, all retiring. But retirement's nothing new, is it? Well, yes and no. We all know what retirement means, but let me put a face with it. This is my husband's grandfather, General Underhill, and he had a magnificent career in the Marines, and he lived to be 100 years old. Let's unpack that a little bit. He joined the Marines in 1913, and he retired in 1946. He had a 33-year career. And when he passed away at age 100, he had enjoyed a 45-year retirement. Yeah, 33 years working, 45 years retired. Now, some of you are probably wondering, am I really prepared for 20, 30, or 40 years of spending? And that's a decent question. But back in the day, living to 100 was something really remarkable and special. And now it's become a lot more common, hasn't it? So in 1935, President Roosevelt started the Social Security Administration, and at that time, the average life expectancy was 62. For men, the average life expectancy was 60, and yet they set normal retirement age at age 65. They never imagined that there was going to be this tsunami of baby boomers all retiring. In the next 15 years, we will have 73 million people retired all at the same time. We're going to see more people retiring over the next 15 years than we have seen in the entire history of our country. And that's an important thing for us to all grasp. And I'm not saying this because I want to startle you. I'm telling you this because you need to know the truth. And you need to know that in order for you to protect yourself, your family, and your retirement, you're going to have to take the bull by the horns. And so that's why you've come here today. We're going to learn some ideas and strategies and tools that you can use to implement to make a big impact in your life. Because you deserve to have the retirement that you've worked an entire lifetime dreaming about. So let's get started. Hi, my name's Mickey Butler, and I'm a CLU CHFC and a financial advisor with Retire by Design. I've spent the last 20 years as a trainer, and in the last 20 years, I have learned as much from meeting with people like you and getting all kinds of wonderful, challenging questions as I did getting my licenses and my degrees. So thank you all for those opportunities to learn. And today we're going to be talking about taxes in retirement. So let's talk a little bit about what retirement really is. Retirement changed drastically in 1985 when our benefit plans shifted away from pensions and over to 401k plans. Ever since then, what retirement has been like is you being a good saver, climbing to the top of a mountain, getting to the top of the mountain and having a number on a page and saying, okay, this is it. And then asking yourself, how am I going to convert this into a stream of income that will last the rest of my life? Because you will spend the rest of your life spending. Some people say that retirement is like a series of Saturdays, the most expensive day of our week. But it's interesting because for mountain climbers, most of the fatalities happen on the way down from the mountain because there's a lack of oxygen at the top and people are tired. Retirement's a little bit like that. In fact, I've heard people say that they are afraid of running out of money before they run out of breath. So what are the most common questions that I've heard in talking with people just like you? Well, I hear very often, when can I retire? And I've also heard, how much income can I safely pull out without running out of money? And then today we're here to talk about the third question I often get, which is, how can I avoid taxes and the other costs that are going to reduce my wealth and my income? So what we're going to cover is Social Security and taxation of it. We're going to talk about your Medicare premiums and how those are impacted just as if it were a tax. And most of all, we're going to learn what you can do by knowing the rules of the game and how you can control your taxable income so that you can reduce those taxes and costs that I call stealth taxes. Okay, so let's get started with a pop quiz, because after all, retirement is really one lifelong pop quiz, and we just don't know what's going to be on the test. But this is going to be an open book test. Our tax system is graduated tax rates. Every one of us has got dollars inside our taxable income that are taxed differently. So what we're going to talk about today is going to be those dollars that sit at the top of the pile. And we're only going to be talking about federal income taxes because some of you live in different states. So when you add a dollar to the top of the pile, it could be taxed at a higher rate. And what some of you might be surprised to learn is that it could create an additional stealth tax that you weren't even aware of. So here's our quiz. This is Michelle. She's a retiree. Her taxable income is $42,475, and she is smack dab in the 22% tax bracket. $38,000 of her income comes from her IRA, and $25,000 comes from Social Security. Her favorite grandchild is getting married. So she decides she's going to tap her IRA for $1,000 to make a very special wedding gift to the lovely couple. How much tax should she owe on that $1,000 wedding gift? Well, she's smack dab in the 22% bracket, so it should be $220, right? Unfortunately not. This is a victim of stealth taxes, so she owes $407. That's a 40.7% tax rate on that additional $1,000 of income. So we're going to dig down deep and understand how this happened to her. Now, some of you are wondering why, and some of you are grabbing your calculator and your pencil, and you're going to try to figure this out. That's what I would do too. But I'm going to encourage you just to sit back and listen, because there are going to be some materials here, graphs and charts that you're going to want, and I'm happy to share them with you. So let's just go ahead and look at this from the big picture. Before the wedding, Michelle's income was $38,000 from her IRA, and after it was $39,000. So we all know she had a $1,000 increase in her IRA income. But what else happened? Michelle's adjusted gross income went from $56,525 to $58,375. As a result of this, and what you're going to see in a moment about how Social Security is taxed, she wound up having taxable income that was $1,850 more by virtue of that $1,000 wedding gift. This is the Social Security stealth tax. And that's why she had an increase of $407 of taxes, because her income tax went from $51.34 to $55.41. Let's take a look. Now, for those of you who are already collecting Social Security benefits, you know that every January you get a statement from Social Security. It's a 1099. And so Social Security has got a funny little formula that we're going to look into a little bit here. For your combined income, as far as Social Security purposes go, your adjusted gross income includes non-taxable interest, like things from municipal bonds, Plus, it includes a percentage of your Social Security benefits. Now, the website says 1/2 of your Social Security benefits, but it could be 85%. And that's what happened to Michelle. So here's the chart. A single person who makes between $25,000 and $35,000 is going to have half of their Social Security pulled back into their income. And when their adjusted gross income goes up by one single dollar to $34,001, they have to pull 85% of their Social Security income back into their taxable income, or $28,901. For married couples, because there are two of you, you can have between $32,000 and $44,000 that are of adjusted gross income. And that would mean that half of your Social Security is taxable, or $22,000. But once you go $1 over that limit to $44,001, you pull 85% of your Social Security back in as taxable income. And when you take a look at these jumps in income, for example, going from $22,000 of Social Security being taxable to $37,000 of Social Security being taxable, that's significant. So isn't January a little bit late to do anything about this? I mean, when you get your 1099 from the Social Security Administration, what really can you do? Well, I agree if that thought's going through your mind. It's a little bit like driving your car through the rear view mirror. But what I want you to know is there are some things that you can do. But there's another surprise that waits for people that we need to cover, and that is the survivor's taxes. You know, when a married couple loses one spouse, the survivor shifts from married filing jointly to single. And that's a big tax hit. But then you have to add on top of that bracket creep on Social Security taxation, because in that chart we looked at before, you go from having a larger amount of income being taxed at, causing Social Security to be taxed at a lower rate, to a smaller threshold. So Social Security income, it might not be includable in taxable income. 50% of it might be includable in taxable income, and 85% of it might be includable in taxable income. And this is only one facet of the income tax story with regard to Social Security. But let's talk about what is the definition of taxes. In my opinion, tax is any cost that increases as your income increases. And some of these are pretty silent. So, do you remember the first time that you played tic-tac-toe? I could ask you, do you remember the first time you lost at tic-tac-toe? Because your opponent probably knew the secret. Your opponent probably knew that if they got to make the first play, and if they could take the center box, they most likely would win. This is the same thing. But it's important that you always seek tax guidance. The reason that's important is because you've got three different taxation on your assets. You've got traditional IRAs that are tax deferred. And when you pull any money out of those, as long as you're not paying a penalty for early or late withdrawal, any money coming out of those will be taxed at ordinary income tax rates. And then you have Roth IRA assets. And those assets will those grow tax deferred. And if you follow the IRS rules, they'll come out tax-free. And then you've got tax-deferred assets. And those are assets where you've put money in on an after-tax basis, where you have a cost basis, and your gain is going to be taxed at capital gains rates. So let's talk about what really happens when you cross that threshold from working to retired. You know, a lot of people in their accumulation phase, they have mortgage interest deduction, they have child tax credits, they have tax-free employer-paid medical insurance, and they can contribute to 401k plans. But as soon as you flip that switch, your situation changes, because now you're not only in the spending phase of retirement, but you've got to know these Social Security taxation rules. You've got to understand IRA minimum distribution rules. Now you're paying for Medicare, and the question is, how much will you have to pay? And you're going to have long-term care expenses and unexpected health events. So you might be thinking, well, at least when I retire, I will be in a lower tax bracket. The truth is, that's not necessarily true. You do get an extra personal exemption at 65, but only if you itemize. And again, we have to look out for that stealth tax. Now, folks, why am I doing this? I do want to educate and inform people about this. I want you to know more at the end of this 40 minutes than you knew coming into it. But quite frankly, I'm also looking for redemption, because I was that person who encouraged people always to put as much money into their IRA and 401k as they could possibly afford to spend, because I told them, when you retire, you'll be in a lower tax bracket. Well, as my systems became more sophisticated and I began to see people who were actually retiring in a higher tax bracket, it made me change my tune. So I'm looking for redemption by getting the truth out to people. And I also do have a passion for helping people enjoy the very best retirement that they can. So what are the stages of retirement? It's funny because when you're in pre-retirement, you might not even be thinking about this. But the fact is, you have got a tremendous opportunity to control your savings and do it in a very strategic way so that you're positioned to save taxes in the future. But when we traditionally think about retirement, we think about somebody who has left the workforce in whole or in part. They're in their 60s to 70, and we call that the go-go years. Now, the go-go years is when you want to check things off of your bucket list. It's when you want to spend extra money because you've got wonderful, good health, and you want to enjoy some of those things you've been dreaming about. Then at about 70, people tend to slip into the slow go years. Now, slow go, you can still go, you just maybe don't feel like it as much as you used to. Now, ironically, at that moment when your attitude towards going and spending has downshifted a little bit, that's the very moment in time when the IRS is imposing the required beginning date, or RBD, that they want you to pull money out of your retirement accounts. That's been shifted to age 72. And then the last part of retirement, when you're in your 80s, is also a very expensive time because of healthcare costs. So we encourage people to think about retirement as a big smile. You want more income in the beginning, probably are going to want less income in the middle years, and then you'll need more income in the later years. So let's talk about how somebody takes all of this into account to develop a plan. We've talked about the 4 stages of retirement, and now we're going to shift into the strategies that you can use to control your bracket. And we're going to uncover some more about the stealth taxes, which is taxes on Social Security once you collect, increased Medicare premiums, and possible surcharges and other taxes. So you have to ask yourself, will the IRS rules create an income that suits your lifestyle? Or is it going to create a situation that you pay more taxes than is absolutely necessary? So there are a few other retirement surprises that we have to include. One of them is inflation. One author has said that you need to have a strategy in place to triple your income in retirement in order to keep pace with inflation. We certainly are all familiar with market fluctuation. Unexpected healthcare costs can and will come up. Government benefits can reduce, and certainly tax laws are going to change. And we're going to talk about one that changed recently and how important it is. But what I really want you to know is that all of this is underscored by longevity. You see, the longer we live, the more time that we have to be subject to these retirement surprises. So longevity, which is what we all want, is really financially a bit of a two-edged sword. So you might be thinking, okay, but at least I have Social Security going on. And that's true, but let's talk about how does Social Security really integrate into someone's retirement plan? You might be one of those people who decides that you're going to retire completely, and that's great and awesome. But you might be one of the people who fits into the other 3 categories. You might stay within your current job and semi-retire, or be a consultant, or work part-time. Or you might shift into a semi-retirement and do something that you've always dreamed of trying. Or you might retire and volunteer. So let's talk about your actual Social Security benefits and just one little picture of how you can optimize those. So how are they calculated? The Social Security Administration goes back to your entire earnings history, and it grades up your earlier earnings years by inflation, and then it has a formula and it applies your highest 35 years of income to what your ultimate benefit is going to be. So the year you start your income also impacts your benefits and taxation. But there are those two factors. How do you get that adjusted income monthly benefit highest, and when you start? So let's talk about early retirement. You know, a lot of women that I've worked with have found that they had to take a break from the workforce to take care of family or parents. And so what I want anyone who is taking early retirement at age 62 to know is this. And when you earn money from 62 until your full retirement age, you can increase your Social Security benefit. You can earn yourself a raise at full retirement age. And you do this by having your post-62 earnings replace a potentially low or zero year in your 35-year history. Now, here's the bad news about collecting early and working. Not only did you take a discount on your Social Security benefit, but now they're going to withhold $1 for every $2 that you earn over and above $18,240. And then there's the ugly part. If you work even after you're collecting Social Security, whether it's early retirement, early collection, or at your full retirement age, you're still going to pay the Social Security tax, whether it benefits you or not. And it's only going to increase your ultimate benefit if it is one of those years that replaces one of the average 35 years. So let's summarize this. If you're working and collecting Social Security early, you might increase your future benefits at full retirement age, but you also might reduce your Social Security benefits today. You might or might not increase your future benefits, and you will definitely pay taxes on your earnings, even if it doesn't increase your benefit. Okay, but you can't change the Social Security rules, right? They are what they are. Well, there's a lot you can do today. You can go, if you haven't yet, go to ssa.gov and set up your account. Check your earnings history and see if there are any mistakes. You might be surprised how often I've had people find years in the middle of their employment when a zero income was reported. You need to consider benefits from former spouses, like a deceased spouse or a spouse from whom you're divorced. There are different rules that apply, and it can be a little bit technical there. But you need to design a withdrawal strategy that responds to your changing income and tax needs. So, you know, if you're like any other people that have seen this, you've got questions. And folks, the questions tend to be rather delicate and intimate, especially because your decision of when to collect and how to optimize your benefits has to do with not only your earnings, your current spouse's earnings, and maybe even a former spouse's earnings. And it could have to do with whether you're caring for a dependent into your retirement. So I'm encouraging you, if you have any questions, please feel no obligation to go ahead and click the box. Let's have a quick 20-minute talk and maybe we can get you an answer. Okay, so this is a very, very important piece of legislation that impacted us in December 2019. This was the first law that was passed in 13 years to impact our 401k and IRA accounts. And you know, it became, it fell into the shadow of the events of spring of 2020. So I don't want our short time together to pass without bringing this to your attention. Your required beginning date is now age 72. It's no longer 70 and a half. And for a very few people who took their 70 and a half withdrawal this year, they have an option to pay it back. And your heirs and beneficiaries now have an entirely new set of rules of how they can receive your balances. So we're going to take a look at the chart and how that works. But before we do, please know that Roth IRAs were not covered by this distribution regulation before, and now they are. I want you to know, particularly if you have got a beneficiary who is disabled or chronically ill, or if you have named a beneficiary that is a trust, you've got to pay special attention to this next chart. So please jot down, check your beneficiary designations, and also please add a contingent beneficiary to your accounts. So this is the chart, and it's a bit busy. We're not going to dig down deep into it today, but your beneficiary's distribution rules have to do with how old you are when they inherit the account and which category they fall into. A spousal beneficiary always sits in the royal seat, but any other beneficiary that you have is going to be subject to some pretty complex rules. And if you have a trust that is named as a beneficiary, I can get you some resources where we can review that, and you can know whether it's going to be treated more judiciously or if it's going to be treated more liberally as the distribution goes. So, wow. You might be thinking, I kind of hope you're thinking, what else don't I know? Well, let's talk a little bit about Medicare premiums. This is my friend Irma. She's a waitress down at the diner. Actually, IRMA really stands for Income Related Monthly Adjustment Amount. Now, what does that have to do with anything? IRMA, Income Related Adjustment Amount, is the formula that Medicare uses to create tiers. And inside those tiers, it's determined how much your Part B and Part D premiums are going to be. And it uses your modified adjusted gross income from 2 years previously. That's important to know too. So if you thought that Michelle's example was pretty gnarly, wait until you see George and Martha. So George and Martha both have Medicare Parts B and D. They have $271,500 in modified adjusted gross income from 2018, 2 years ago. They make a decision to liquidate a stock position in their portfolio, and they're only selling off $1,000 worth of stock. Now, if you just looked at the charts from the IRS, you would think that they owe $188 of capital gains tax. But that couldn't be further from the truth. In fact, you won't believe this one. So their Part B premiums went up, and let me explain why. Part B premiums are determined by this chart. Single filers who have less than $87,000 of modified adjusted gross income would pay $144.60 per month of Medicare Part B premium. A married couple whose modified adjusted gross income, or MAGI, is less than $174,000 would each pay $144.60 per month. And then it goes up from there. So what happened with our couple, George and Martha? They jumped a gap. They went up, they went over the IRMA cliff. They went from paying $289.20 each for their Part B up to $376 per month each. That's $2,038 of additional Medicare Part B premiums just because they liquidated a $1,000 stock position. Their Part D premiums jumped too, and I'll give you a moment to look at this chart a little bit. But at the end of the day, they wound up having an increase of $461 for the year for their Medicare Part D premiums. So when you add their increased Medicare premiums together, it's an increase of $2,544 for the year. Now let's tally that up with the tax that they actually owed for the capital gains on that stock sale. And what we see is that they have taxes and costs of $2,732. Folks, that's a 273% real tax rate. So here's survivor surprise number 3. We know they go from married filing jointly to single. We know they can experience bracket creep on Social Security taxation. And the chart that you just saw that reflects the Part B and Part D premiums, because they would drop down to the single rates, they could actually experience bracket creep on their Medicare premiums as well. So I can't let the opportunity go by without saying, hey, you need to be sure to sign up for Medicare Part A on time. If you sign up late, you'll pay a 10% penalty for life, and premiums increase every year, and that means the penalties would too. That could translate into tens of thousands of dollars. So watch for coverage gaps on this. I've got some resource materials on this decision as well, so don't hesitate to reach out to me and I can pop them into you. All right, so let's summarize. Your Medicare Part B and Part D premiums are determined from your adjusted gross income from 2 years ago, and you could pay a penalty for life if you don't sign up on time. There's some other strategies that might benefit you. And one of those that I think affects a lot of people is using your IRA to directly make charitable donations. The reason this is effective is because instead of pulling that IRA money back into your taxable income and experiencing income taxes and some of these other stealth taxes, and then donating it, remember that a lot of people are not itemizing. They're taking the standard deduction. So because of that, shifting to a direct donation to your charities is going to be beneficial. And you want to get that ball rolling in about November. The other thing that you could do from an estate planning perspective is, if the situation presents itself, you can transfer assets that have got a higher gain on them into the name of the person that you anticipate would have the earliest mortality. And the reason for that is because the surviving spouse would inherit that asset with a step up in cost basis, and effectively you would wipe out all the capital gains on that. You can move taxable accounts to tax deferred or tax free. This is a huge, huge benefit for people who just sit down and take the time to get help and find out how to do that. And you can find more tax-free income. There are additional strategies. But please, please remember, please tell everyone you know, every IRA and 401k beneficiary needs to be reviewed since December of 2019. So you have to plan how and when you're going to use taxable assets like your 401k and your IRA. You need to strategically plan how you use tax-free assets like Roth and other assets, and tax-deferred assets like brokerage and savings accounts. So now you know how you can avoid the stealth taxes by planning your income. So my income determines how much Social Security is taxable and how much I pay in Medicare premiums. Yes, and you are in control of that. You see, this is the really interesting part. There could be some years when your objective is to keep your income below a threshold so that you don't bump into a higher bracket or make yourself subject to these stealth taxes. However, you could also have other years where your objective, in order to reduce your lifetime tax bill, your objective might be to increase your income so that you can fill up a lower tax bracket and have that money there preserved for later. So, you know, Doing nothing is just like letting the IRS go first. It's just like letting them have the middle box because you see, folks, we can't do anything about the tic-tac-toe board. The rules are the rules. It is what it is. But you have got the X's and O's in your hands. And if you act proactively, you get to play them in a strategic way so that the IRS does not necessarily win. So which account should you spend first? Now, it's interesting because when I introduced myself, I told you about some designations I hold. Those account for about 18 postgraduate courses. This is what I had to memorize to pass the test for those designations. Spend taxable money first, spend tax-deferred money next, spend tax-exempt money last. And that is what the, quote, rule of thumb is. But you know what? Maybe rule of thumb isn't good enough. Here are 3 books that have been written that refute that rule of thumb and conventional wisdom. So, you might be, I hope you're not discouraged, but you might be thinking, well, if the experts don't agree, how am I supposed to figure all of this out? Folks, you're not. If you've got a guide with the right tools, and by right tools, I mean the proper software that bakes in Social Security taxation and Medicare premiums on top of everything else, that guide can get you up the mountain and back down safely and save you taxes. And saving taxes is going to mean you'll have more money to last you the rest of your life. But each person needs different tools and strategies. But everybody needs a roadmap. Everybody needs tax-efficient distribution strategies. Everybody needs retirement income planning. And most people need Social Security optimization. Because the IRS default plan, if all we do is follow the IRS rules, we're not going to have that smile retirement. It might not create income that suits your lifestyle, and it might not be designed to save you taxes and costs. So I'm inviting everybody to take a 20-minute complimentary Get Acquainted meeting. Now, some of you think that you're too young to need this yet. And what I want you to know is you're in a powerful position to build some strategies. So no, you're not too young. Some of you think that, well, it is what it is. I've already retired. There still are strategies available for you too. But I really want to talk to that group who already has a financial advisor. I want you to go ask that financial advisor if the planning tool that they're using for you takes into account any increase in Social Security taxes or Medicare premiums in addition to everything else. So what happens in our 20-minute meeting? Well, it's just like this. We'll be on Zoom. You'll be in the comfort of your home or office. I'll be here in my home office, but you do all the talking and I do all the listening. And you get to get answers to your specific questions. And hopefully I can refer you to some resources that you can use right away. Because I want you to be able to feel confident about your future and happy that you've done something positive. I want you to do something like start with the middle box. Thank you so much for your time. Appreciate you.